something that I thought about when I was reading your paper, and you, as you stated up front, you very clearly said that this is just looking at government as a financial institution. However, given what we've got happening in Europe and all around the world, I wonder if you would talk to us a little bit more about other sources of systemic risk that might arise from government, just to give us a taste of what we might perhaps be or should be looking at in more detail.
Okay. Okay, a taste. So quite clearly the buildup of sovereign debt has to be the biggest concern from what governments are doing. It's clearly responsible for what's going on in Europe. That's the most obvious example. And I think you also see you see risk from government insurance programs, and there's sort of classic papers on this, but for instance in the United States you have flood insurance that encourages people to build on bad places. To the extent you get a lot of people having insurance, have them taking more risk, it can become a systemic risk. But I'm going to say I'm giving a bad answer to that question, and I'm going to stick with my first answer, which was simply the buildup of sovereign debt. I think most of the other places where government is a source of risk, I sort of alluded to. So I think I didn't just talk about financial institutions, I also talked about the regulatory framework. And I think the regulatory framework is a good example. Maybe I'll give you one more that comes to mind, which is in places where the government is a very large fraction of the capital market, they can also lead to a big buildup of risk. So today in the United States, the government, which used to guarantee maybe 50 to 70% of mortgages, they now guarantee over 90% of mortgage origination. So we have essentially no private mortgage market left in the United States. Well, what does that mean? It means that all the rules that the government has for who qualifies, who doesn't, how much down payment do you need, what kind of mortgages can you take out that have this government guarantees, the government is making all those rules. So the decision making in that market is highly concentrated in a very small number of institutions, or really one institution, which is the federal government. So I actually believe that the reason the government is a source of systemic risk is because of the concentrated decision-making that comes out of the government. It's very centralized, so you don't get a diversification through that.
Tim Clark from IAG, the insurance company.
What about the systemic risk? I always think about it as almost regulatory overshooting in response to crises. SOX might be a classic example, Solvency II, and it just takes so much activity from the private sector to comply that you take the focus off actually thinking about risk. Your views on that?
I certainly agree that was part of the motivation for this sort of line of thinking, which is that you have an event where clearly there were excesses in the private sector, and it leads the government to think, well, we're going to put on a lot of regulations, we're going to stop a lot of activity, and in fact, we're not even going to have you do it, we're just going to do it ourselves, which is sort of the case of the US mortgage market. We had a meltdown of the mortgage market, and instead of the government trying to figure out how to get out of the way of the private sector, they've stayed squarely there. I mean, it's sort of something that's very notable is ground zero, and I apologize to all of you, of the financial crisis was the US mortgage market, right? And it's the one thing that the Dodd-Frank Act didn't address at all. It sort of said, well, you know, Fannie Mae, Freddie Mac, all too complicated, and during this time of crisis, we just can't work that out. And so sort of ironically, the place where that risk arose. So yeah, for all those reasons.
Yes, we're going with that.
Thanks, Professor Lucas. Noel Watson from Insurance Australia Group. I'm interested in your research. A lot of what you spoke about there was around the federal government. And I suppose I'm interested in, as financial actors, state governments as well, and whether in your research you'd like to comment on both the size and interconnection between state and federal government?
Yeah, that's such an interesting question, because it's true that I think in the US, more than a lot of other countries, a lot goes on at the state and local level as well as the federal. I emphasize the federal because I do think it is the largest issue in the United States, although the states can also get into trouble. And I alluded to the main place where the state governments are at risk, and it's for their pension systems. Right now, as you probably know, it's being tested in the courts to what extent they can pull back on the benefits. So it's actually, this is an issue for lawyers, not for me, but the situation is that state constitutions protect the benefits of those state workers. And so even if the state governments would like to somehow retract some of those guarantees or some of those benefits, it's quite hard to do. But now we're starting to see situations where some local governments are going bankrupt. And, we're yet to see who's going to bear the incidence of that. I mean, I think something will happen. I actually don't think that the states are, I think my own prediction is the states are going to find a way to reduce those benefits. Another issue is that some of the benefits are for health and not for retirement. And those healthcare benefits tend to be less protected by law. So you are seeing a lot of cutback there. Really, I think the question in terms of sovereign risk in the U.S. is whether, if the states default, whether the federal government would step in. And I wouldn't trust my prediction because I could so easily be wrong. But my guess is the federal government is going to do their best to not bail out the states, because it would be just a terrible precedent. So hopefully the sovereign risk is ring-fenced a bit. My own state is one of the most underfunded, and I own a lot of real estate. I think, what economic theory says is that the present value of the taxes that you have to pay are impounded in your property value, which may be part of the reason I'm having so much trouble selling my old house in Chicago now.
Gordon Menzies, University of Technology. I wondered if you could comment on the role of specialisation in systemic risk. That is to say, as government tasks get more and more cut off into different institutions, for example, a central bank hiving off bank supervision to a separate institution, whether that creates externalities of information between them, and how you think about that in terms of systemic risk.
Yeah, I think there's a very interesting question about the efficient industrial organization of government and how you want the regulatory system to be organized. I think there's risks on both sides. So there's, as you may know, in the academic literature, people have made the case for having a single regulator. And I think a lot of people in the United States would like to see the Federal Reserve be the primary financial regulator and have more power, because they believe that the Federal Reserve is more independent, that they make better decisions, that they're less susceptible to political influences. So that's the argument for concentrating that regulation within the central bank, at least in the US structure. There's a concern that when you have a number of different bank regulators, there'll be a race to the bottom, that they'll compete for lenient regulations, and that will cause a problem. So there's an argument for centralization. On the other hand, I think what you saw in the negotiations around Dodd-Frank is that the Federal Reserve didn't want to be the regulator of choice for every single financial institution. I think in particular they wanted to duck out of regulating the housing enterprises because they felt like if they were regulating everything, then they would be a focal point for congressional interference. So I think if you have one key regulator, then you may be more susceptible to political pressure in another way. And then again, you get back to this issue of diversification. So I'm not sure that I want one head of one agency to have all the power. I mean, just the problem with dictators. You're happy if you have a benevolent dictator, if they're wise, but you're not always going to have a wise, benevolent dictator. So I think I see trade-offs everywhere. And,
one. Greg.
Yeah, I'm Greg Medcraft from Asset. Prior to being back in Australia, I was on Wall Street for a decade and was in securitisation, examining the American industry. I must say I agree with your thesis about creating systemic risk. It always shocked me, the mortgage market, the US mortgage market, the 30-year mortgage, non-recourse, 30-year fixed rate, prepayable without penalty is a great free option. And even in the student loan market, as you say, isn't a great example of moral hazard. It's quite interesting though. I think it's a tragedy if they miss the opportunity now to not allow the private sector to create real commercially viable mortgage market or student loan market. I think actually it's quite a shock when you go to the United States and you realise what is supposedly a free enterprise economy, the level of government intervention in the economy. Actually, for us in Australia, it's actually quite impressive, frankly, is the level of intervention in the economy. So, I do agree with you. It's a real pity that it would be, even at the moment, one of the issues, the loan limit for housing. I mean, they could reduce it to try and allow the private sector back into the economy, and I'm just not sure they have the political will to do that, which is a bit of a pity. Just another comment on the Federal Reserve. My experience of the Federal Reserve and having one central regulator is what I saw in the United States was they really don't have a great understanding of the intricacies of capital markets and how they really work, and I saw that with the subprime crisis, in dealing with them. They didn't really understand the intricacies of really capital markets and the way they work. So I think there's a counter to having a centralised body that perhaps it's almost, you can't cover everything. So I think that is a risk in itself. So just a comment, yeah.
I'll just say that we're entirely on the same page. Everything you said, I agree with 100%. Certainly, the U.S. mortgage market is very vulnerable because of the 30-year mortgage. And I don't know if you know where the 30-year mortgage came from, because it is a terrible idea. I mean, a 30-year fixed-rate mortgage with a free prepayment option is extremely risky for investors. And I always say that any instrument that creates great risk for investors isn't good for consumers either, because every once in a while it brings down the whole financial system. It actually turns out that the 30-year mortgage was an invention of the Federal Housing Administration. So it was a government invention, and it's not clear that it would be particularly sustainable in a private market. There is actually, so I attend a lot of conferences on this sort of issue of what to do with the future of the housing market, and I think at least a lot of academics, a lot of people in the business understand the vulnerability of a 30-year mortgage, and it's important to inform policymakers. They like 30. In the US, the 30-year mortgage is like apple pie. It's very hard to get rid of. But another point you make, which is very important, and I don't know how much it's true in other places, is that the regulatory agencies in the United States, for the most part, don't hire financial economists. And it's partly, perhaps, because of the very large difference in salaries between Wall Street and the government. The government can't pay very much, and what happens is they wind up, particularly the Federal Reserve, with macroeconomists who switch over to try to talk about the financial system, and they don't really have the intuition of the private sector. That makes it difficult. I'd say that during the financial crisis, the place where you did see more expertise go to Washington was that there was quite a lot of people who went to Treasury. So at least in the time of crisis, investment bankers, people with expertise are willing to go to Treasury, but it's not a permanent arrangement, and it doesn't deal with this knowledge gap between the private sector and the